Kraft Heinz is down 23% year to date at the 52-week low, offering a yield of over 5%. Are we potentially looking at a company that is severely undervalued? The market has oversold the stock, and should we expect to see some strong growth of KHC over the next few years and see a yield on cost in double digits? We're going to take a look in today's episode at Kraft Heinz, looking at the historical performance of the company. Jumping into the income statement, their revenue growth, top line and bottom line net income growth over the last few years, as well as a health check on the balance sheet, looking at their total cash versus total debt. We're also going to look at the comparatives and their competitors, how they've performed total return year to date, as well as the last 5 years. And we're going to see what are institutions doing. Are they buying or selling Kraft Heinz company? This is going to lead us nicely into that all-important dividend safety score and some very important financial metrics you need to understand before investing in KHC. And as always, we will run it through our stock valuation model, getting to our intrinsic value and finding our acceptable buy price given our investor margin of safety. Now, it is down 23% year to date, and investors who have been holding the company over the last 10 years would have seen negative 41% return on their investment, which is shockingly poor, even though that doesn't include those dividends reinvested. So are we looking at a very cheap price of a company with a very strong brand and with a starting yield of over 5%? Can we expect to see our yield on cost over the next few years be in the double digits? Well, let's take a deep dive into the company's financials, starting with their income statement and their top line revenue. So what I personally like to see is around 3 to 7% growth year on year on the revenue. And what we can see, 26.3 billion reported in December 2018, with their latest annual report showing around 26.5 billion. So minimal growth over the last 5 years. A slight red flag indicator there already, especially given inflation being 4% year on year. It doesn't look like in real terms it's growing. Now, in terms of year on year growth, while 2018 to 19, we see a drop on the top line before it picks up. It remains relatively flat and a very small increase in December 2022. So some slight inconsistencies here on the top line, not real or any much real growth in all honesty. How does the bottom line net income compare as well? So we see December 2018, a huge 10 billion net loss in 2018, 2022, 2.4 million net income. So it has gone the right way over the last 5 years. However, again, on a more granular level, whilst we do see an increase in 2019, we see this then drop in 2020 before picking up to 21 and 22. So inconsistencies across the board, and we will take a look at the last 10 years percentage-wise as well, but so far an inconsistent company. Now, before we look at the balance sheet, do bear in mind, just because a company is inconsistent doesn't mean there is money to be or money not to be made, and we'll take a look shortly at that too. So in terms of the balance sheet review, a quick look at total cash versus total debt. They held around 1.1 billion of cash in 2018. Latest quarterly report, a very small drop to 947 million. So again, we can see not real much difference of cash on the balance sheet held. How does that compare numerically and directionally to total debt? Well, what we can see, interestingly, 2018, 31 billion of total debt held. And when we take a look at the latest quarterly report, 20 billion. Now, I like this a lot already as I'm analyzing it. They had around 31 billion, and now this has dropped to around 20 billion. So not only have they essentially paid off a lot of their total debt, but their total cash position from the last 5 years, as we can see, hasn't really moved that much. So very positive to see. Right now, I'm liking what I'm seeing in terms of the balance sheet. Now, a few companies in a similar industry, the consumer staples, packaged food and meats. We can see the Hershey Company, General Mills, Danone and a few others, especially Hormel Foods, which I have recently reviewed on the channel. Now, in terms of total return year to date, how does KHC effectively perform? Well, we can see it is one of the worst performing out of their competitors year to date, but bear in mind, companies in general year to date, other than those technological ones, have fared fairly poorly. But again, even against their competitors, we do see these two here performing much better. Now, over the last 5 years, interestingly, how has Kraft Heinz performed in relation to the competitors that we see above? Well, what we can see, in fact, they have had, again, negative returns, which is very poor, especially when you include those dividends reinvested. So what I would say is, although we look at historical performances, it is never an indicator of future performance, just always good to see when analyzing a company. Now, what are the institutions doing? Firstly, they hold around 75% of the company, but what is more interesting is over the last 12 months, 1.63 billion institutions have been selling shares in Kraft Heinz, whereas just shy of 7 billion have been buying. So a significant amount of institutions are now buying Kraft Heinz. And what we can see here, Q2 of 2023, 3 billion have bought shares. So it's interesting, institutions do seem to be liking the price currently of Kraft Heinz, but just because an institution is buying shares doesn't mean we should. And as always, we should do our own due diligence and reviews. Kraft Heinz now we're leading into the borderline safety dividend at 50. Not the greatest score, but we will delve deeper into that shortly. Market cap 38.6 billion, making it a large cap company. Now, in terms of recession data, what we can see, they didn't pay a dividend in 07-09, so it's difficult to use that as a comparative, and we have no recession return. But what we can see is, in terms of the growth during the 07-09 period, they had around negative 5% sales. Now, whilst this was essentially negative, what we can see, this was above the average growth of companies during the S&P 500, which was negative growth. Now, in terms of dividends and their growth, now they haven't had a dividend increase since 2019. In actual fact, the last few years from 2019 has remained relatively flat. The last 5 years, negative 8%, last 20 years, 0%. So very, very poor in terms of that dividend growth. And as we can see, they've had 0 years of consecutive increases. Now, whilst the yield is above 5%, let me just say one thing. If you are not getting an increase in your dividend, your other income producing asset or salary at a minimum of 4% year on year, you are essentially losing your purchasing power and taking a pay cut, as the US inflation rate over the last 40 years was 4%. So bear that in mind. Now, dividend yield theory states that the company is undervalued when the current yield sits above the 5-year average. As we see here, 5.09 versus 4.59, our first sign of undervaluation. But bear in mind, we never look at any model in isolation and draw our conclusions towards the end of the episode. Likewise, forward PE 10.9 versus 5-year average of 13.5, another sign of undervaluation. And our third and final sign, sector PE significantly higher than that of Kraft Heinz at 10.9. Do bear in mind, whilst I did say at the beginning of the episode, it is towards the 52-week low. 52-week low does not signal undervaluation. Likewise, 52-week high does not signal overvaluation. Earnings versus free cash flow. Now, it's very important, and this is going to be a good example to see. We tend to ignore the earnings. It is susceptible to manipulation by management through their accounting, and therefore I tend to look at the free cash flow. What do I like to see? Personally, 60% or below, and what we can see for the large part, it has been very, very inconsistent. And this is why now I'm going to tell you why we tend to ignore the earnings. If we were to look at the 2022 earnings, we'd look at 58%, say that's very, very good, below the 60% that I personally prefer, as it means, in my opinion, management can offer those double-digit dividend increases. Now, 2022 here on the free cash flow payout, 126%. Now, what this essentially means is the company is paying out more in dividends than they are generating in free cash flow, and is a red flag to that dividend safety that we can see why it's a 50 borderline safe. One thing I would say though is expected in 2023 to come all the way down to 47%. So again, it does give some comfort if management are able to hit this target that the dividend will be safe for now. Earnings per share, again, data is here for those investors that like to look at that. I'll focus the attention on the free cash flow. Negative 4.06 in 2013, very poor. 2022, 1.27 with 2023 at 3.42. Now, yes, what we can see here, very, very inconsistent year on year, but there isn't really any positives I can say, unfortunately. However, this could be a turnaround play if you expect KHC to turn things around, and we are looking through these metrics as well as the valuation shortly to understand whether or not this is possible. Now, sales growth year on year, 3 to 7% is what I mentioned, but as we can see, negative 1% in 2014, negative 1% in 2017, 1% in 2018, and again, lots of negatives. So here, it's not a company that is essentially growing that top line year on year. Very inconsistent, and on top of that, it's not even being the 4% inflation. So in real terms, their revenue is decreasing. Better shown here below numerically, 11 billion in 2013, 26.5 in 2022. Now, whilst that looks positive, over 2 times growth on the top line. When you take a look from 2016, it has barely moved that top line. So in real terms, taking into inflation, it is in fact decreasing. So we move on to essentially the shares outstanding. Now, we love it as investors when companies do share buybacks, returning excess cash into our pockets. But notice they do the opposite thing at KHC, where they've issued shares 2014 to 15, 2015 to 16 before remaining relatively flat, which essentially dilutes your position as a shareholder and is a big negative. If they've done this once before, they are likely to do this again. Now, ROIC, one of my 7 golden dividend metrics. If you want to see the other 6, do check the pinned YouTube video. What we're essentially looking for here is 10% or more. The reason for this is, in my opinion, it means management are able to effectively allocate that capital. What we can see consistently, they have underachieved year on year. So there isn't really any positives I can pull out from this. Hopefully in the future, it can start to increase over 10% or 10% at the minimum. But as we've seen over the last 10 years, it hasn't really hit that. Operating margin, positive in my personal opinion, it is above 16%. The higher the margin, the higher that bottom line net income should be, which means dividends paid out and dividend increases. But it has been dropping, or it has been dropping from 2017. So it is slightly worrying. It's something that I would keep a close eye on in 2023. And the free cash flow margin, what we can see, very inconsistent. Again, seems to be a general theme for KHC. Now, one thing I really like about this company, and I know it sounds weird given how much I have said have been quite negative or red flag indicators, is they have been paying off that debt as we saw in the balance sheet review. Net debt to earnings for interest, tax, depreciation, amortization. What we look for here is 4 or below, 4 signaling the number of years it would take the company to pay off all their debt net of cash on hand. Whilst it went above that in 2018, what we can see is it has been coming down below 4 considerably, 2.68 in 2022, 2.47 in 2023. So this does give me some faith that dividend will be safe for right now in the near future, unless anything else dramatic happens. And on the right, we can see the net debt to capital, showing us the percentage of companies financing from debt as opposed to equity. As always, if value is being provided, if you are enjoying the content, help the channel out massively, smashing the like button, hit the subscribe and bell if you haven't already, to have these videos drop to your doorstep every single day. And again, if you want to grab a copy of the valuation model to get your own intrinsic value for KHC or other companies in your portfolio, do click on the pinned comment below. Now we're jumping onto the first valuation model, Graham's valuation. We have the earnings per share at 256, growth rate per analyst estimates, and that current yield on AAA corporate bonds, giving an intrinsic value of $31. As we can see, essentially bang on the current trading price. What this signals, based on Graham's valuation, the current trading price is at a fair value. Do bear in mind, as we always say, we never look at any of these models in isolation, and we'll draw our conclusions towards the end of the episode. The second model we have is multiples valuation model. Companies in a similar sector and size, we have Kellanova, General Mills, Hormel Foods and Hershey, of which we have recently reviewed Hormel Foods on the channel, as well as General Mills and Hershey. We have their stock price, EPS, PE multiples. We get the average multiplied by that of KHC to get a multiples valuation price of $49, showing some significant upside to the current trading price, above the 52-week high, and showing signs of severe undervaluation in the current market. We then move on to the third model, the dividend discount model with the yearly dividends. As we can see, there's been many years of no growth, and especially a year of a dividend cut. So average growth, negative 7%. Now, forward looking, I would be hoping that they do increase that dividend to around 3%. You could argue it's slightly optimistic, but as always, if you do justify a high or low percent, grab a copy of the model and we can see what your price gets to based on your estimates. So the DDM price comes to $33, roughly in the current trading price, around 7 to 8% upside, but well within that 52-week price range, showing some signs of undervaluation, but also you could argue reasonable valuation. We then move on to the discounted cash flow model, DCF model, with the year-on-year free cash flows. Growth around negative 24%. Now, forward-looking, analysts are more optimistic, looking at around 12%. Coupled with a discount rate at 8%, we see the present value of future free cash flows and terminal value. Add that with the cash, subtract total debt, arrive at the equity value. Divide by the shares outstanding to give a DCF price of $34. Around 10% upside to the current trading price, still within that 52-week range and showing signs of undervaluation in the current market. As always, the intrinsic value is essentially the average of the 4 models that we have just run through. And if you do enjoy the content, value is being provided, smash the like button and hit the subscribe and bell button to join this lovely community. So the intrinsic value at $37, What do I say is a margin of safety? Well, I'd advise essentially 10% if you believe it has a wide moat, strong financial metrics, good forward-looking data, which would mean it's a buy up to $33. Now, personally, with KHC, we did mention a lot of red flags, so I think 10% is way too low of a margin of safety. 15%, you could argue, is essentially the current trading price. So based on the estimates and judgments of today's episode, 15% margin of safety would be the current trading price. Now, those looking at 20% would be looking at an acceptable buy around $29. As we can see, that is slightly lower than the current trading price. Now, personally, if I was to add this, I would want a much larger margin of safety at around 25%. So I would add this to around $27. Whilst it is below the 52-week low, it's not to say it won't come and hit that price. Wall Street, on the other hand, believe there'd be some nice upside above the intrinsic value at just shy of $40. As always, let me know your thoughts in the comments below. Do you believe KHC to be a buy? Are you looking to sell or purely on the sideline speculating? As always, do leave a like if you did enjoy the value of the video. And if you do want to grab a copy of the valuation model to get your own intrinsic value, whether it's for KHC or companies in your portfolio, do click on the pinned comment below. As always, have a great day. Catch you on the next episode and take care.